Yeah, I think the three reasons why you'd invest in private debt is one, the stability of capital, and that comes from the terms, conditions that are negotiated with companies, the security that is held over those companies, and the way in which you monitor and assess risk, and the floating rate nature of the loans that are held in the portfolio. That provides a degree of stability of capital that other asset classes don't have, together with the private market nature of the assets, where you're not subjected to a lot of investor liquidity issues determining the value of the assets. It comes down to the core fundamentals of credit, which is the company generating sufficient cash flow to pay and repay your debt, that delivers the stability of capital and protection. So as a sound and a responsible lender, should be making loans that are going to provide for full repayment. A second area of reason or interest for an investor is the alternative source of income that's generated. And so from our perspective as a lender, what we're doing is we're negotiating with the company to ensure that the company pays a fair price for the loan that we provide, but equally it's a return, it's a source of return for investors, and therefore we need to value our investors' capital to ensure that when we provide funding to a company, we're providing on fair terms and conditions at a fair price, but it also recognises the value that you're creating for that company. And so the fees and the interest that is charged to a company reflect the negotiating skill of the manager, which provides a source of income for investors. And that regularity of repayment and servicing of the interest provides a source of income for an investor. So that stability of capital and the income that is there. I think the other thing that is attractive about the Australian market is the Australian market actually is quite an immature debt market. You've got a situation where the four domestic major banks have really crowded out other investors, and they hold those assets on their balance sheet. And so the ability to access non-bank sources of debt financing for a company are quite limited. And so companies are looking for diversification of funding away from the banks. And so what we provide to companies is an alternative source of debt financing, but what we provide for investors is diversification across a broad range of industries, which lowers the risk associated with investing in debt. Yeah, those investors that have got a higher risk tolerance, we have products and funds available for them. So for instance, our listed MOT, the Metrics Income Opportunities Fund, or our wholesale fund, our credit trust, is designed to provide investors with opportunities in higher yielding debt or debt where we can take equity interest in the company. So it's really about us originating transactions that meet the mandate criteria of the respective funds that we operate. But what we've found is that as we've become larger and our funds under management become larger, you're more relevant to the borrower, which means that the kinds of transactions that you can originate are better for investors, and you can deliver a higher return for investors through the skill set of origination, negotiating with a client, structuring different transactions to provide the funding. But equally, we've recently launched the Metrics Real Estate Partners Fund, which is giving investors an opportunity to not only invest in our skill set in private markets in debt, but also looking at ways in which we can provide investors with the opportunity to invest or co-invest along some of our existing property development clients and participate in the equity associated with those development transactions. So for us, we're very much a private markets origination and management firm. We manage private market assets, originate those directly with the different companies that we seek to do business with, to provide investors with a return and a risk profile that is consistent with the objectives of the various funds that we operate. And I think, fortunately, if you look back now over our 8.5, 9 year period since we've been operating, the track record that we've delivered to investors has been consistent across our various funds. Yeah, it does. Obviously, as we've become larger, the capacity to be more relevant to larger borrowers and to be able to do larger transactions presents in the form of opportunities that you wouldn't have if you were a smaller manager. And so I'll give you an example. If you're a manager and you say you're managing $100 or $200 million, and a borrower wants to borrow $100 million, you're not going to have a concentration of one borrower in your portfolio. So one of the ways in which you manage credit risk as a private markets lender is to ensure that you've got good diversification where you don't take significant exposure against any one individual borrower. And so as you become larger, the opportunity to participate in larger transactions is available to investors. And if you can solve for the capital requirements of a company, then obviously you're more relevant to that company, which means you can capture more of the upfront fees that are charged to the company to structure, originate and provide the financing.